We live in an interconnected global economy where tariffs play a significant role in shaping international trade. While navigating the shifting landscape of global commerce, companies are facing a range of financial and operational risks that can threaten their stability. In this course, Insure to Endure, Managing Risk in a Time of Tariffs and Trade Wars, we look at a powerful tool to manage these risks. Trade credit insurance is a type of coverage that protects businesses against non-payment due to customer defaults or delays. It also offers valuable insights into customer creditworthiness, helping businesses improve their cash flow and financial planning. For Canadian exporters, understanding how tariffs impact trade and how trade credit insurance can help manage those risks is essential. This short course explains the 6 ways trade credit insurance, also known as Receivables Insurance, can help businesses trade securely in challenging and good economic times. Trade credit insurance supports businesses by protecting against buyer default, improving access to financing, aiding in market expansion despite the risk, providing stability and cash flow, providing a strategic advantage, and by monitoring risk and intelligence. We'll go through each of these benefits individually. The most common goal of a receivables insurance policy is to protect against buyer default. Let's look at how it works. During turbulent economic periods, the likelihood that buyers, both domestic and international, may be unable or unwilling to pay increases significantly. International markets are affected by tariffs and political tensions, while domestic customers can be similarly hurt, either directly or indirectly, by the domino effect when their customers' customers are bankrupted due to the economic stress. Trade credit insurance protects businesses from commercial and political risk if a domestic or foreign customer fails to pay due to insolvency or bankruptcy, delays payment beyond agreed terms, this is called protracted default, or cannot pay due to political risk, for example, foreign government actions or currency restrictions. Let's better define commercial risk and political risk. Commercial risk includes the insolvency or bankruptcy of a customer, or a protracted default, where the customer simply fails to pay within the agreed time frame. For example, a U.S. distributor hit by tariffs may experience cash flow issues and default on payments to a Canadian supplier. Political risk is when selling internationally, there's the added risk of political events impacting payment. These include currency restrictions, import-export bans, expropriation, war, or government interference. For instance, if a Canadian company exports to a country where the government suddenly imposes capital controls, the buyer may be unable to remit payment, even if they want to. So let's recap. Trade credit insurance protects businesses if a domestic or foreign customer fails to pay due to insolvency or bankruptcy, delays payment beyond agreed terms, or cannot pay due to political risk. The key benefit of trade credit insurance when protecting against buyer default is that the insurer reimburses up to 90 to 95% of the invoice value, depending on the policy terms, protecting the business from severe financial loss. This gives Canadian businesses more confidence to sell to both existing and new customers, even in volatile regions. And new customers will be vital to the survival of many businesses, as existing customers reduce or eliminate their purchases to accommodate the new economic reality. Let's move on now to benefit number 2, improved access to financing. As mentioned at the start of this course, Insure to Endure, we outlined the 6 ways trade credit insurance can help a business trade securely at home and abroad. To recap, Benefit number 1 is protection against buyer default. Number 2 is improved access to financing. Number 3, market expansion despite the risk. Number 4, stability and cash flow. Number 5, providing a strategic advantage. And number 6, the monitoring of risk and intelligence. In this section, we'll focus on benefit number 2, improved access to financing. In uncertain economic climates, banks and financial institutions tend to tighten lending criteria. Trade credit insurance can enhance a company's creditworthiness by making their accounts receivable more secure and reliable. A company can use their accounts receivable as collateral. With insured receivables, companies can pledge their outstanding invoices as high-quality collateral to secure loans or lines of credit. They can also get better loan terms. Lenders are more likely to offer favorable terms, lower interest rates, longer repayment periods, larger lines of credit when repayment risk is mitigated by insurance. An accounts receivable policy can also improve liquidity because businesses can maintain steady cash flow even when payments are delayed or customers default, which is crucial for managing operations and growth plans. For example, a Canadian electronics manufacturer may use trade credit insurance to secure a higher working capital line from its bank, even while facing declining orders from tariff-impacted U.S. customers. This next video will provide some clarification. Taking a receivables insurance policy to the bank. A medium-sized scooter manufacturer is experiencing good growth opportunities, especially from international markets. 50% of their $200 million in annual sales are from foreign markets. So far, their foreign receivables have been internally funded rather than being financed by a lending institution. But this approach is beginning to limit their opportunities. Their average accounts receivable is $30 million, their gross margin 20%, account turns per year 7, and credit management is handled by the corporate controller. When considering a receivables insurance policy, their key objective wasn't to manage credit risk, but instead it was to leverage assets within a borrowing arrangement, freeing up capital so they could maximize on all selling opportunities, both domestic and international. The company's solution was to use receivables insurance to transform pledged accounts receivable into assets that the lender would view as risk-free. This approach would give the company an increase in margining, the inclusion of foreign receivables in the borrowing base, and eliminate concentration limits, all at a lower interest rate. The result was a program that was projected to make available approximately $15 million in additional working capital for the company, which would easily fund their growth plans and provide a cushion. So let's recap this section. Trade credit insurance can enhance a company's creditworthiness. It can improve access to financing because insured accounts receivable are more secure and reliable. Accounts receivable can act as collateral. It can help get better loan terms, and it can improve liquidity. In our next section, benefit number 3, market expansion despite the risk. When traditional markets become uncertain due to protectionist policies or economic instability, businesses may be forced to look at new regions or sectors, both domestically and abroad, for growth. But unfamiliar markets come with unknown risks. In this section, we look at benefit number 3, market expansion despite the risk, and how trade credit insurance enables Canadian businesses to pursue new opportunities with confidence. There are 3 ways that trade credit insurance helps businesses pursue new opportunities with confidence. First, it provides a secure entry into emerging markets. Businesses can insure sales to buyers in emerging markets where political and payment risks may be higher, but the opportunities are growing. Second, it can help businesses test new customers. Insurers provide risk assessments on potential buyers, helping businesses make informed decisions about credit terms and customer reliability. This also greatly facilitates businesses that respond to economic circumstances by altering their product offering. The revised offering can lead to a new set of customers, which can be vetted through a trade credit insurance policy. And finally, it can help a company respond to supply chain shifts. As companies reroute supply chains due to trade wars, credit insurance mitigates the payment risks of doing business with new customers that are introduced as a result of supply chain alterations. As an example, a Canadian agricultural exporter exploring markets in Southeast Asia can insure its receivables to avoid exposure to unfamiliar credit environments. Watch this next short video as it further explains how receivables insurance can be used for sales expansion. Receivables insurance for sales expansion in foreign markets. ABC International Food Traders has offices in Toronto and provides a marketplace for both buyers and sellers. In addition to market maker services, ABC also provides logistics and intelligence to its clients. It's a big world full of opportunity, and ABC is looking to expand their business into foreign markets where the business and legal environments are relatively unfamiliar to them. They understand the need to mitigate the risk of non-payment from buyers in these foreign countries and to protect against adverse political conditions, so they consider some options. They could have the prospective buyers pay up front, but ABC's foreign buyers don't have the working capital to pay for their purchases up front. And if the company is unable to provide terms, the buyer would simply look for another trading partner. They could choose not to sell to these countries, but much of the demand and growth for services provided by ABC are from overseas markets. The company can't afford to lose business opportunities as a result of being unable to offer credit terms to prospective international customers. There is another solution, though. ABC worked with their insurance broker to find a cost-effective receivables insurance policy that would enable trade for ABC as an exporter. This was crucial because it gave ABC the ability to offer 60 to 90-day credit terms to their overseas buyers, and this made the company more competitive. ABC's receivables insurance policy covered them for up to 90% of the value of unpaid invoices. Their credit insurer also had a collections company with local offices across the globe to ensure an effective debt repayment strategy. And with the competitive terms they were able to offer to these foreign customers, ABC was able to grow their business. It's no wonder their management team sleeps better at night. So here's a quick recap of the 3 ways trade credit insurance helps businesses pursue new opportunities with confidence. A changing business climate can prompt companies to look at new markets, including emerging markets. And with a trade credit insurance policy, businesses can access new opportunities by insuring sales to buyers, even where political and payment risks are higher. In addition, insurers provide risk assessments on potential buyers, helping businesses make informed decisions about credit terms and customer reliability. And as companies reroute supply chains due to trade wars, credit insurance mitigates the payment risk of doing business with new customers that are introduced as a result of supply chain alterations. Our next section is benefit number 4, stability in cash flow, and we'll look at how trade credit insurance cushions businesses from financial shocks. Volatile markets often lead to payment delays, strained business relationships, and unexpected cash flow gaps. In Insure to Endure, benefit number 4 of trade credit insurance is stability in cash flow. Trade credit insurance cushions businesses from the financial shock of customer defaults, making cash flow more predictable. It provides revenue protection. Even if a key customer fails, Insurance ensures businesses don't suffer catastrophic revenue losses. The insurer reimburses up to 90 to 95% of the invoice value, depending on the policy terms, protecting the business from severe financial loss. Trade credit insurance can be used for budgeting and forecasting because knowing that receivables are backed by insurance allows businesses to forecast revenues with more certainty. And trade credit insurance can also help with managing fixed costs because with insurance in place, a sudden large default won't prevent a company from meeting payroll, paying suppliers, or investing in operations. Let's take a look at an example of how trade credit insurance provides stability and cash flow by cushioning businesses from the financial shock of customer defaults. A common instance is where the lender, who calculates a line of credit based on the existence of accounts receivable collateral, is forced to collapse that line of credit or even call the loan because of the disappearance of collateral as a result of the bankruptcy of a buyer. The trade credit insurance policy provides a safety net to that collateral, so the lender need not take these actions. This video illustrates the impact a bad debt can have. A bad debt loss can be devastating to a company and can have lasting, if not fatal, consequences on a business's future. Let's consider what could happen to Wayne's Wheels. The operating facts are these. Wayne's Wheels business is booming with annual sales of $50 million. They have a gross margin of 10% and a net margin of less than 1%. Annual sales to their biggest buyer, Mod Rod Scooters, is $5 million, with purchases made regularly throughout the year. It's a busy year. Orders keep rolling in, and Mod Rod's payable climbs to $1 million. Suddenly, Mod Rod's largest buyer, the scooter stop, files for bankruptcy. This results in Mod Rod Scooters not being able to continue in business, and they leave a debt owing to Wayne's Wheels of $1 million. Yikes! Wayne's Wheels has just unexpectedly lost 10% of its sales. Its cost structure with a gross margin of 10% means that to recover the costs associated with the bad debt of $1 million, Wayne's Wheels will have to generate over $9 million in new sales to pay back its suppliers, never mind the cost of running its business. Considering that the starting point is already 10% less due to the loss of Mod Rod Scooters as their largest customer, it seems unlikely that Wayne's Wheels will ever be able to recover, and they're destined, in the absence of credit insurance, to follow in the footsteps of Mod Rod Scooters. So let's recap the 3 ways trade credit insurance provides a business stability and cash flow. Trade credit insurance offers businesses revenue protection because even if key customers fail, insurance ensures businesses don't suffer catastrophic revenue losses. It helps with budgeting and forecasting because knowing that receivables are backed by insurance allows businesses to forecast revenues with more certainty. And it helps manage fixed costs. With insurance in place, a sudden large default won't prevent a company from meeting payroll, paying suppliers, or investing in operations. Coming up in our next section, we look at the strategic advantage that trade credit insurance can provide businesses to help them take a more aggressive, customer-friendly approach. The uncertainty brought on by the shifting landscape of the global economy causes many businesses to be conservative with credit terms. In Section 5 of Insure to Endure, we look at the strategic advantage trade credit insurance can provide a business. Having trade credit insurance coverage can help businesses take a more aggressive, customer-friendly approach, enabling them to offer competitive credit terms. Because insured businesses can offer net 30, net 60, or even longer terms, giving them an edge in negotiations. And by accommodating customer cash flow needs by extending credit, insured businesses strengthen relationships and gain repeat business and enhance customer loyalty. Another strategic advantage of having a trade credit insurance policy is that it can help increase a customer's liquidity. Offering open account payment terms that are insured as opposed to requesting your customer post a letter of credit will free up the working capital that is supporting your customer's letter of credit and improve their liquidity. Offering favorable credit terms while managing your own risk is a powerful value proposition, especially in global supply chains, and it can set you apart from your competition. Let's look at an example of a Canadian manufacturer selling to EU buyers. The EU buyers want net 90 terms. The Canadian manufacturer is backed by credit insurance, and they could win those contracts when competitors aren't willing to risk extended repayment periods or when they're asking for customers to post letters of credit. This short video explains why open credit terms are so important to the buyer and the seller. You remember Weeby Manufacturing? When they purchased a receivables insurance policy, it helped them quickly and securely grow their business 200%. This was due in part because it enabled them to use open credit terms for new and existing customers. Why are open credit terms so important? Open credit terms mean the supplier is providing the buyer with goods or services based on a sales contract that says they will pay in the future. Whether you know the buyer or not, this can be pretty scary. So why do it? Because buyers need the financing offered by trade credit from their suppliers in order to survive and grow. And if you don't provide these terms, your competitors likely will. With a credit insurance policy in place, Weeby Manufacturing was able to apply for credit limits on existing and new potential buyers, and the insurer, by agreeing to amounts, provides a binding opinion on the creditworthiness of those companies. With this reassurance, Weeby Manufacturing was able to increase their sales on buyers they might otherwise have avoided and achieve new growth. To recap the strategic advantages of a trade credit insurance policy, it allows businesses to offer competitive credit terms because insured businesses can offer net 30, net 60, or even longer terms, giving them an edge in negotiations. And by accommodating customer cash flow needs by extending credit, insured businesses strengthen relationships and gain repeat business, thereby enhancing customer loyalty. By replacing letters of credit with insured open account payment terms, you help to free up your customers' working capital. And trade credit insurance can help you stand out from competitors because offering favorable credit while managing your own risk is a powerful value proposition, especially in global supply chains. Coming up next in Insure to Endure, we look at benefit number 6 and how trade credit insurance can help you monitor risk and access intelligence. Most trade credit insurers provide access to detailed credit information, monitoring tools, and professional risk analysts. In Insure to Endure, this is benefit number 6, risk monitoring and intelligence. When you have a trade credit insurance policy, your insurer can help you monitor risk and intelligence. Consider how your business could benefit from pre-sale risk assessments. Before extending credit, businesses can get real-time reports on a potential customer's credit rating, payment history, and their financial health. Insurers track buyer performance and alert businesses to deteriorating risk profiles, and this ongoing monitoring enables businesses to act before issues arise. And some insurers include access to country risk reports, industry trends, and early warning signs of trouble in international markets. Let's look at how Weeby Manufacturing outsourced their risk monitoring and intelligence with a trade credit insurance policy. Support your credit management with Receivables Insurance. Weeby Manufacturing was a growing company experiencing tremendous sales opportunities both domestically and abroad. The growth potential was exciting, but they didn't know these new customers, and they needed assistance in determining whom to sell to and whom to avoid, because they couldn't afford to risk valuable working capital selling to financially unstable accounts. The company had annual sales of $140 million, average accounts receivable $20 million, gross margin 8%, and account turns per year 7. Credit management was handled by the manufacturer's management team. Management's objective was to outsource the credit analysis function, which would provide expert advice and allow Weeby Manufacturing to safely grow their business. Their solution implemented a credit insurance program that provided the insurer's expert credit risk assessment on the manufacturer's medium and large accounts, and implemented continuous monitoring on all covered accounts, freeing up the manufacturer's management team for other business activities. In addition, the policy was customized to provide immediate credit decisions for new medium-sized accounts. This program produced immediate results. Sales were made to new and existing accounts on open credit terms that the manufacturer would never have entertained prior to the adoption of the credit insurance program. Weeby Manufacturing successfully grew their business by 200% during the initial policy period and is projecting to generate approximately $350 million in revenue over the next year. So to recap this section, let's look at how your business could benefit from risk monitoring and intelligence provided by a trade credit insurance provider. Insured businesses can get pre-sale risk assessments. Before extending credit, businesses can get real-time reports on potential customers' credit ratings, payment history, and financial health. Insurers track buyer performance and alert businesses to deteriorating risk profiles, enabling them to act before issues arise. And some insurers include access to country risk reports, industry trends, and early warning signs of trouble in international markets. Coming up next on Insure to Endure, some final thoughts on why trade credit insurance is more than just a safeguard for business. We've now covered the 6 powerful benefits of trade credit insurance in today's environment. With the frequency of trade disruptions, economic slowdowns, and geopolitical instability, trade credit insurance is more than just a safeguard. It's a strategic tool that enables Canadian businesses to trade confidently in both export and domestic markets, to grow safely and securely, to protect against uncertainty, and to unlock financial flexibility. Tariffs are creating a complex and often unpredictable environment for Canadian businesses. In this shifting landscape, trade credit insurance has become a vital tool for managing risk and protecting financial stability. As companies work to adapt, developing a deeper understanding of how trade credit insurance works and how to use it strategically will be essential. This knowledge can help businesses safeguard their growth and stay competitive even amid economic uncertainty. Leading trade credit insurance providers operate in Canada, each offering tailored solutions to help businesses manage risks associated with non-payment, especially during times of tariffs, trade wars, and economic uncertainty. Receivables insurance brokers are specialists who assess a business's needs and then get quotes from those insurers who come closest to meeting those needs. Both specialist brokers and insurers are members of the Receivables Insurance Association of Canada, REAC, and they can help if you have questions about receivables insurance, trade credit insurance. Talk to a Receivables Insurance Association of Canada member to find out how trade credit insurance can benefit your business.